Hello and a very warm welcome to Invest Africa. During this program, we'll bring experts, business heads, fund managers, CEOs, and chairmen of reputed companies to share their experience and their analysis of the current economic situation in Africa and their gut feeling. First, we take you to our expert, Mr. R.K. Gurumurthy. Mr. R.K. Gurumurthy is the treasurer of Bank One Mauritius. His analysis has been regularly quoted by international media. In every program of Invest Africa, he will give his expert analysis about the investment opportunities in Africa and global financial situation. Mr. R.K. Gurumurthy.
A very good morning and a happy new year to everybody. 2013 has started off on a very positive note. S&P and a few major indices have reset multi-year highs. But we look back to that 2012, what happened, one gets an impression that what a year it's been. Looking back, what started as a credit crisis and what started as a liquidity crisis in 2008 with the demise of Lehman Brothers has been well managed, I should say. First half of 2012, investors are wary of the major markets. The bond markets are not doing well, nor were the equity markets. We saw the China Shanghai index falling to multi-year lows. We have seen a great recovery in the last half of 2012, and especially the last month of 2012 has seen significant rally in most of the major markets. Now let's look at what started this rally and how this happened. To start with, the European Central Bank took very positive actions under the stewardship of Mr. Draghi. They announced what is called as an OMT, which allows the central bank to pump in liquidity and buy the bonds issued by the various sovereign nations. So that brought in the confidence. The confidence that was lacking in the initial half of 2012 was back in the market, and we saw investors returning to the market in a big way. 2013 promises to be a good year. 2013 also promises to be a year of unraveling. If 2012 was a period of waiting where the investors wanted to see where to put their money in, 2013 appears to be providing a clue. In the last week of December, the Federal Open Market Committee, or the Central Bank of the US, came up with its policy minutes, which suggested that they may soon sometime unwind the liquidity measures they have been holding on for quite a few quarters. That sent markets on a tailspin, and we saw some of the rally that saw in December coming back. But then that's too early, I would say. If you look at the first week, the data coming out of the US and then the employment numbers, they don't appear to be indicating that the economy is back on keels and it is recovering. Let's go back to the Eurozone. Eurozone also appears to be on its own for a while, but we do have plenty of auctions coming in. So that leaves the emerging markets back in focus. Let's look at some of the key emerging markets, for example, Brazil or Russia or India or China. China nearly hard landed, but it was well managed, and it should more be a positive decisions to have that hard landing. India has been behind the curve. India's GDP growth has not been up to the mark, and you can see that in the various inflation data released over the years or the quarters. That leaves Brazil and Russia as the two key markets. But what is emerging as a very promising destination lately is South Africa, Turkey, Korea, Indonesia, and to some extent Mexico. Let's look at what's happening in South Africa. An upgrade by Citi included the South African bonds issued by the Central Bank of South Africa as an investment grade that entitled investors to invest in South African bonds. That was a big positive that gave a lot of strength to the currency markets as well. But towards the end of October, November, we saw the miners' strike, whereupon the industrial production took a knock, and what was supposed to be a 3+ GDP growth for the economy suffered. South Africa is undoubtedly the world's 28th largest economy, the 5th in the African nation. What started as a very promising destination took a backstage when we had this miners' strike. There was a bit of unemployment, and in fact we had a lot of layoff and all. South Africa also, by the way, has a 25% unemployment, which is one of the highest among these stronger emerging markets. Notwithstanding all that, South Africa is also a rich natural resources nation. In fact, the mining industry is doing exceedingly well. At a time when Federal Reserve is expected to keep the system liquidity in for quite a consistent longer period, I think it should favor commodity currencies and even the commodity economies like South Africa. South Africa, the other major concern the investors have been, inflation has been 5.6% and it's veering towards 6%. But we should also say that it's also an opportunity because it is also a symbol of growth. In fact, in my view, ZAR will be a strong performer in the second half of 2013. Currently, the South African rand or ZAR is trading around 8.5 to 8.75 band, while we might see it moving towards the 9 or 9.5 level. In the long run, it is going to be a performing currency, and we should be back well below 8. As we stand 2013, where the global economies continue to be infused with a huge amount of liquidity, South Africa appears to be a good destination, and maybe if we start in a cautious approach, the South African bond and maybe the South African industries are a good place to look at. Let's continue this series and let's look at the next week where specific areas in South Africa, specific areas in the emerging markets where we can identify investment opportunities and share with the investor and the viewers. Thank you.
Our economist, Dr. Yusuf Ismail, will bring everyday business personalities from Africa to express their opinions and share their experiences. Today, he's talking to Samir Sharma, who is the head of international funds at iPro Fund Management, and he's also a co-fund manager of the African Market Leaders Equity Fund. iPro was set up in Mauritius in 1992 and is today a leading investment and portfolio managing company, having $500 million of assets.
We have with us today Samir Sharma from iPro of Ciel Investment Group. iPro have some 500 million USD of assets under management in Africa. Samir, we've seen and we've heard a lot about Africa. The perception we get is Africa is one country. It's not one country, is it?
Certainly it isn't. I mean, Africa is divided into many different regions with different growth rates. And obviously where you want to focus on would be a very limited area of operations that could account for roughly about 80% of the GDP of the whole entire continent. Obviously within Africa itself, you have Sub-Saharan Africa, which is sort of the talk of the day, and then you also have North Africa, which has always been a historical investment hotspot destination, which, although since the Arab Spring there's been a bit of some tension. And then you have South Africa, which is extremely developed, and it's a different story that's very much correlated and known to the world or correlated to global markets. So that story is well played out. So when we talk about Africa, as far as we're concerned at iPro, we're really focusing on Sub-Saharan Africa.
When investors are looking at opportunities, they have that lack of guidance. And when you look at the different sector in Africa, people don't have a real understanding in terms of the opportunities, but also the risks in certain countries. In your experience in Africa, can you elaborate a bit more about areas or sectors where there are real investment opportunities for investors?
At iPro, what we essentially do is that we manage an equity fund that focuses on three main themes that we think in Sub-Saharan Africa, excluding South Africa, where we feel there's long-term growth, which can be quite secular in nature. We believe that these are long-term real markets. So we focus a lot, for example, on the African consumer, on the basics of what they consume. And within there, where we focus on a lot is on the brewing space. So African brewing companies. A lot of these companies are multinational companies that list their operations, their local operations in each of these markets, and they have near monopolistic power in each of these markets. For example, in Rwanda, you have a company called Bralirwa, and Bralirwa is essentially has 95% market share and is 75% owned by Heineken. So you know that in terms of corporate governance is a good quality, and you also know that the company itself has the market share it needs in this relatively small and mountainous country with the right distribution channels. So you're essentially holding something that's generating huge free cash flow yields, and you're sitting tight. Now, that's sort of the companies that we look at on the consumer space. We also look at some of the agri space. We're very bullish on agriculture in general. And we want to focus on companies like Zambi, for example, that are there's a Zambian company that does everything from the farm to the fork. So it produces the seeds, it feeds its companies, feeds the poor, feeds the animals, the pigs and the chicken and so on, and so forth, the beef, and then it sells it in the partnership with ShopRite. You see, if you go as an investor, you don't have the money to essentially create a distribution channel, but you do have these market leaders in these countries already have set up the distribution channel and the partnership with ShopRite, for example, which is in the case of Zambi. And that gives them the ability to essentially have a huge market and growing and expanding. So we play around a lot in that kind of space. When I think in the agri space, you need to be quite careful. I think Africa, look, it's 65% of the entire African economy would revolve around the financial sector. It's always like this in a very nascent period of economic development. And banks, to put it this way, banks in Africa, maybe their cost of funding is about 1 to 3%, and their lending rates are about 20%. It's a huge margin that they make. Plus bond yields on the government side are around 10 to 15%. So they make easy money, but obviously in terms of risk management, a lot of banks have had trouble in the past. Non-performing loan ratios have been quite high. In many countries, Nigeria, which is perhaps the largest sub-Saharan African country, excluding South Africa, has had a huge bank bubble that bust about 3 years ago, and that required tremendous amount of recapitalization by something called AMCON. So, the opportunities are quite clearly there in the banking space. Basic retail banking is what people focus on, because if you look at monetary aggregates, you're looking at deposits to GDP of only 14 to 20%, depending on the country. So it's so underbanked that it's easy to make money. And where you focus on there a lot is on the big banks. The big banks can expand in the villages to get the deposits cheaply, and they can go and lend to the corporates in the towns. And that's essentially the way you would invest in the banks if we do it.
And in one of your recent paper, you mentioned the rapid growth in certain countries, Ethiopia growing up to 10% of GDP per year. You also elaborate in certain areas of growth in terms of sector, agribusiness. But you also mentioned, not to use your word, Mauritius must not miss the Concorde. Not missing the boat, but not missing the Concorde, because Africa is growing very fast. But yet, when we look at Mauritius, we've been very sort of lagging behind in terms of getting and grabbing the opportunities that the continent is offering.
I think that the problem in Mauritius is that we try to go it alone, and we're small. And what we don't seem to understand over here is that $10 million is nothing in Africa. And you get laughed at with $10 million at the table, but in Mauritius, 300 million rupees is a heck of a lot of money, especially when the corporate sector in Mauritius right now is extremely leveraged. And so this going it alone approach, when you're small, the access to the projects that you get, especially within private equity or joint ventures, are extremely riskier than if you were, say, a medium scale project or even a large scale project in an already risky continent. And so what essentially happens, a lot of these guys, they go make these long-term investments. There's such a huge period of time before these investments bear fruit, and the process when you're alone and you're small can be quite corrupt, it can be quite deceiving. And you will always have setbacks. I mean, Africa can be a frustrating continent. That's part of the return. The high risk and the high returns that you get from Africa, it's part of the game. And I think that this go it alone approach is one big issue that we have within the corporate sector. Everybody's trying to do their own thing. Every family is trying to have their own little business, but they don't recognize that they're too small themselves. Now we've had Alteo, which was sort of a merger of Dix Privé-Beauchamp of Groupe Ciel and Fuel of Groupe Monloisir. And now perhaps one of the most positive things that has happened in the last few years. Finally, two groups that didn't always used to get along with each other came together and created this synergy. And I think that's actually a good thing because they're trying to get economies of scale. But I think overall, in terms of financial services, you've had, for example, AfroAsia going into Zimbabwe, getting Kingdom Financial Holdings for, I think, around $9 million as sort of a minority stake. But the issues in Zimbabwe are quite huge, and Kingdom is like the 10th or 11th largest bank. It has a huge liquidity overhang, and Zimbabwe rules are extremely tricky. Just the other week, they just, change the way banks can raise deposits within the banking system, increasing the costs all across the place because they have a huge funding issue in Zimbabwe. So imagine a little firm like AfroAsia, which is a tiny little bank that's trying to be something in Africa, getting only access to a very small little bank in Zimbabwe, which is the 11th largest in a very volatile, perhaps the riskiest country in Africa. It's quite risky. And I think within asset management, we are not evolving, we're not getting the government support to create this new industry. There's no concerted strategy by the state to essentially push companies to come together and have the seed capital. And I think that's the key in the financial sector. There's no seed capital. If you don't have good seed capital, your project cannot be credible, or the access to the project you're going to have are going to be extremely small and risky.
And you mentioned the aspect of private equity, which can be an opportunity because most of these firms are going to invest. The biggest problem they have is finding funds. And like you said, going to Africa, for example, trying to raise funds at the interest rate of 25-30%, it's not really feasible to do a project. So the private equity does really become an avenue in terms of encouraging companies or investors to pool money together. We look at the limited partnership bill in Mauritius, for example. So can you maybe elaborate more on how this equity can really make a paradigm shift in terms of investment in the region?
I think the two types of private equity we could consider in Africa. One side is what we call mezzanine financing, which essentially involves it's creating a bond or some sort of debt structure, getting a high yield on that, perhaps equal to or slightly lower than what banks in that continent would give. But in dollar terms, for us, it would be quite attractive because obviously our risk-free rates wouldn't be the same as within the continent. So we have this arbitrage opportunity. So we can go and finance viable projects via that framework. But the second option is to go pure equity infusion and get a seat on the board and so on and so forth. But I think that the main problems that we have again is seed capital, because obviously our local firms, for example, Ciel has a private equity arm within what we call Kibo Fund. And Kibo Fund essentially created a fund called Kibo One, and Kibo One essentially manages 229 million euros. That sounds pretty big for Mauritius, but it's very small within Africa. The opportunity for Kibo in this ironic sense was the fact that you see a lot of these big Chinese firms or American firms who are looking to invest into Africa. A 10 to 30, 40 million dollar project is too small for them. It won't change the makeup of their growth and assets. But you know, for example, investing in a clinic in Uganda, as Kibo has recently done, that's a huge opportunity in a country with such a young population, with a nascent pension fund industry. The potential is huge, right? But you see, huge American firm wouldn't be interested, but we could be interested. If we came together and we pooled the money properly, we could get access to that. But the key is that if we're able to get the seed capital in general with each other from within, with the help of the government, then we could actually create the critical mass required to go and play within the big leagues. And getting also the competence that is required, because you need to get access to consultants, you need to be there all the time. It's a huge budget that you require to do research. And you know, on average, for example, at iPro, we are having 4 interactions per company in an investment universe of 120 companies. That requires traveling expenses, it requires teleconferencing. It's extremely expensive. You can't do that when you're alone. But if no one in Mauritius understands the requirement in a business perspective to come together and grow, then I'm afraid that we just talk a lot about Africa without really doing anything about it.
If I were to be sitting as a policymaker in government of Mauritius, very often you see policymakers as being the heavy hand in terms of not allowing companies to really develop in certain countries, because policies are very rigid, and sometimes too many policies make companies very complacent, and companies don't want to take the risk into going into Africa. So if you were to be sitting as one of the policymakers with a very innovative strategy for the right policies to penetrate the African market.
Well, look, let's take the example of Mozambique. I have a good friend of mine who's been investing in Mozambique, and one of the main points that he makes to me, and I think makes a lot of sense, as a Mauritian Mauritian investment companies, what? Simple. For example, when you go into Mozambique today, it's an extremely corrupt country, let's face it. But Mauritius is also quite a small country, and I think that what we can do, for example, is have our, for example, Board of Investments, have our diplomatic corps, for example, give us access to the right people. You see, if you go and meet the mayor of a town in Mozambique, and he gives you access, okay, here's my project, sir, and you meet him and you get the ambassador or someone that's important within Mauritius who is there on the ground, able to make the interactions better, then actually you get access to the head of the admin. The guy's going to give the licenses and so on and so forth. It makes the process extremely fast, and even legally. You know, because, you know, what's the biggest issue when you have to, when you're going to go and create a partnership with someone in the other side of the world? It's the enforcement of your contract in the courts. And the cost, the legal costs are extremely high even to set up the business and then make sure your contracts are respected. And I think that's why you require a lot of this sort of consortium that I talk about in this paper, what I wrote recently on Africa, wherein you have the government helping out with its diplomatic side, with its, essentially the state itself coming in within these projects, helping out within these projects, because we're small, we're different. We're not India. We don't have that kind of critical mass that we can do our own things, right? So we need a completely different approach than what most countries are doing, simply because of our size factor. And I think that getting access to these countries, governments, policy makers, getting access to the mayor and his admin guys, it could save you 70 to 80%, believe me. So I think that's quite important. Even recently in Nigeria, we were trying to set up a partnership with a company, and it was going to cost us about $100,000 just to get our fund registered in that country. Right? The $100,000 is 3 million rupees. It's a lot of money for a Mauritian company. It made just to register a fund. And you see, but getting access to the right people can save you 80% of that cost, because a lot of that cost is middlemen and so on and so forth, you see. And so I think that's quite key for us as a Mauritian, as Mauritius. And that's what I would advise policymakers, to create this consortium that puts business requirements together. We all come together. We look at a sections we want to focus on. We get scope and scale. So the scope is, where do we focus on? Do we just focus on Eastern Africa, which is close to us, and we try to really integrate into two actors, agribusiness and the financials industry? And so, or do we also look at another aspect? We just let our companies do their own thing.
And also the government, I understand, of Mauritius has appointed 2 roving ambassadors. So if you were to be one of those roving ambassadors, how would you create these opportunities for investors to use Mauritius as a platform to enter the African market?
I think it would be very difficult just to have 2 roaming ambassadors and think that we can actually achieve success in Africa. The requirement is a structure. It is a state and private sector coming together, creating an investment arm that looks about, one, prioritizing Mauritian companies, putting Mauritian companies first. What do they need to go and invest in Africa? What are the viable projects? Let's be fair about it. Let's be honest about it. We can't give money for free. But then what we essentially do is that we say, all right, these are the priorities. And then the revolving ambassadors or any other policymaker who wants to help in Africa will play within that consortium. And then they will at least have a goal. Because you'll have focus, you'll have scope, you'll have scale. And from that, we will be able to focus on the limited area operations as a small country that we need to do when we talk about agribusiness or financial industry. I think that with the DTAs that have been signed today, and I think that's a great thing. Even Nigeria got a DTA recently. Now, a lot of these firms, one of the biggest crazes that's happening in the next 20 years is that you're going to have a lot of funds being set up to invest into Africa. Not only by foreigners, but by Africans themselves. They're creating the investment vehicles and to reinvest across Africa, be it in private equity or listed companies. So you have an administration opportunity to take access. We're, for example, are beginning to look at these opportunities. We're meeting people who are very interested. And then what we're proposing to them is say, look, you're going to do this back office structure, which is sort of low value added, but high volume business. But what we can also provide you is wealth management services as well. So let's try to help you. But to do that and to succeed in the long term, you need, one, trust, that takes time. And second, you need to have the critical mass. No one is going to come and invest in a small-time company. They're only going to invest with you when you're strong. And in Mauritius, we are small and weak. And we need to recognize that first. And once we calm our egos down, I think, and come together, I think then we have a much better shot at achieving success within the continent.
If you were to have your own funds, which country right now would you really look into in terms of focus, in terms of scale, and also in terms of sector specific? Which country in Africa would you?
It depends where you operate. If you're operating like, for example, we are operating in within the listed equity space, we're operating across sub-Saharan Africa into 3 themes. So we don't think about the country as much. It's part of our analysis. We focus on these three things. Banking, African infrastructure. We play that with our cement companies. Anything from the largest cap stock like Dangote Cement in Nigeria, which is 12 to 13 billion dollars of market capitalization, all the way to like $400 million Athi River Mining in Kenya, right? So we focus on 3 main themes, right? Now within private equity, and I think that's where the focus in Mauritius, when you talk about focus, I think that's what we should look at. Within that, I think the Eastern African region is a key focus area for us. Mozambique is very important for us. Mozambique has a port. The problem is that Mozambique doesn't have the infrastructure, the road network. But if we wanted to eventually link a port in Mauritius to Africa, we would need a sister port facility within Mozambique. I think that would be the best place to do it. The only issue we would have right now is that the roads and then the customs and so on and so forth, and the bribes that need to be paid within the structure will make it quite expensive. But I think that's long-term quite viable. Mozambique is a great country. It's discovering gas across the place. There are huge opportunities in infrastructure in Mozambique within the private equity space and real estate in particular. Rental yields there are extremely high, well above bond yields. And I think that makes it an attractive destination to look at. Tanzania is a great agri place to be in. Yields in Tanzania, be it sugar or elsewhere, are extremely attractive. And Tanzania, is a very stable, old-school kind of country. Within East Africa. And you get to play the East African community. East African community, Rwanda, Burundi, Uganda, Kenya, Tanzania. These countries are increasingly integrating themselves with each other. And that's creating tremendous growth opportunities. And I think that with trade barriers being gradually lifted, you have a huge opportunity for Mauritian companies like Alteo, for example, who has TPC in Tanzania, to essentially grow their businesses and get great tariffs. And in a region where per capita consumption of sugar is extremely low by global standards, I think we have huge opportunities, especially when the yields are high, the costs of production are quite low. The only issue is always power, obviously, in these countries. Power is extremely expensive in Eastern Africa. And if you want to transport in that rim, because there used to be Somali pirates, the insurance costs can be quite high on the freight side. So we need to try to find how we're going to link all these products together. But I think that's a great focus area for us in terms of limitations. Kenya is a huge market, but we can get access to Kenya via Tanzania.
Samir, how do you attract African investors into Mauritius?
I think, look, it's going to be quite difficult, because Mauritius has been going through a huge cycle of boom already that's been 20 years in the making. And I think that boom period is almost over. We are saturated with shopping malls, we're saturated with hotels. And quite frankly, I don't think an African bank would be interested in setting up shop in Mauritius, because we don't do a lot of value-added services within the financial industry. The key for us is to showcase that ourselves we can do the value-added. For example, at iPro, we are the only Mauritian company that manages an African equity fund. But we're small. So why would they come to us when we're so small? They would only come to us if we, for example, partner already with other Mauritian companies, and we grew a certain critical mass, and we showed them that we were very serious people within the continent. And I think that this is what we're required to do, introspection. What business model do we need to succeed within Africa, right? And I think then we will succeed. I don't see any investment opportunities in Mauritius per se. In a continent like Africa, in the hotel industry, where you have occupancy ratios in Accra of 80%, where you can have a payback period of 3 years, to come and invest in a hotel in Mauritius and get return on equity of 3%, I don't think it makes a lot of sense. I think we need to now think about ourselves as being a platform. We need to think about ourselves as being a place where we bring businesses together and we provide them opportunities within the African subcontinent. And then we participate by getting profits, and by our stocks going up, or the private equity ventures turning profitable. And then we get a profit on that. And I think then that comes back to the country. And we do this via a consortium. And I think that's what we need to focus on right now. I don't see a lot of opportunities for us in Mauritius. We can try to attract more tourists from Africa to come to our resorts, but I don't think that Africans right now are ready for that kind of Eurocentric model that we operate.
Samir, it was a pleasure having you on the show, and it was a pleasure to have your experience shared.
Thank you.